YouTube channel. Come back and see them again. We'll put some links in the chat during the presentation. A link to a survey. We'll also put a link to where you can see the videos and things like this if you want to go back and do this. And with that, I will introduce everyone who's at home and in the room to our amazing guest, who we're so grateful for Maisha to be here. She's been a supporter of the rec since really the beginning, since it started in 2020, and we're just so grateful that you could be here with us today. And I won't take up any more of your time. I'll let you get started. Anybody at home, if you have questions, please do. You can either put them in the chat or just turn on your microphone and let us know. And we want this to be interactive, so please do. Let us know.
I was going to turn on the gallery really quick just to see everyone, but I don't know how the heck to do this on this one right
if
here.
I can, if I can do the
It's
view
like
for the-
moving.
Oh, when you're sharing screen.
Oh, I can't. Okay.
Never
All right,
mind. Well, I'll maybe bring something for you to see over here. We'll bring an extra one.
That's
perfect.
great. All right. Well, hi everyone, and hi everyone in the room. I wanted this to just be an open session. So I have some slides that can drive some of the thinking, but one of the things I shared with Tanya is if there are questions that come up along the way, please just stop me and we can get them answered. And that includes anyone on the phone. So I think, Angela, you'll be helping me to understand if there's chats.
We locked in the chat.
Awesome. Well, I do lots of things, but one of them is I sit on as part of a syndicate called New Fund Ventures. I sit on the board there, and I am also a member of this angel investing syndicate. And one of the great things that has come from me being a part of it is I've really gotten insider information into like who really gets funded from angel investment groups and who doesn't. And I wanted to use this session to really just give all of you information about what does your business need to look like? How do you know if you're ready for that level of investment? And what the heck do angel investors even think about? So that's really what we're here to do today. So slide one. So we'll talk initially about the various types of funding. So I know that many of you are probably pretty early stage in your businesses. And so we'll talk about what funding looks like from the beginning all the way through to when you might be ready to go to an IPO even, right? Fingers crossed, all of our businesses to that level. And then we'll talk about what angel investors look for. And, hint, it's really about return on that investment, which is why some of the things that we'll talk about start to matter. And then we'll talk about what you can do to present your business in the best light. And I actually think some of these tips that we'll talk about are not just if you're seeking angel investment, but they also could be very, very helpful if you're seeking a business loan or even if you're pitching to friends and family. And then all the way throughout, it's Ask Me Anything, but we'll definitely make sure we save time at the end to ask any questions that you have. So let's talk about what an angel investor is. So these are individuals who have opted to pull their money together if it's in a fund, which is the syndicate that I'm a part of. And we basically say we want to fund businesses that have a lot of potential, but don't necessarily have the capital today. And most of the time when we think about angel investors, they're going to be your first kind of outside dollars that you end up getting from a company. And by the way, for those in the room, I feel like I'm right like in the middle of the slide. So I'm just going to move over people on Zoom. Oh yeah, we're on this one. All right. Okay. Better, yeah. Okay, good. And so when we invest as a syndicate, as an angel investment group, this is when there are multiple people. So in the syndicate that I'm a part of, which used to be called Tech Coast Angels, and now it goes by the name of New Fund Ventures, there are about 300 of us who are in this fund from all over the country. A lot of us are in San Diego, but there are some people who are on the East Coast as well, and in the Bay Area. And so typically the folks who I see who are part of New Fund are people who have had their own exits from companies. So they're very successful entrepreneurs which comes in handy because it's the angel investor is not just about giving you money, but a lot of times these are places that you can go for advice about how to grow and scale your business too. So that background as an entrepreneur comes in handy. And then a lot of them are also business executives who are either still working or who have retired and are really looking to continue to have a different outlet to grow their investment dollars. There are specific kind of criteria to be an angel investor. So these are usually high net worth individuals who have some money to basically lose, because I would say, probably 90% of the dollars you may not see back. And so this is where we diversify. So any of you who've taken finance will know this idea of diversification. And that's really what we try to do, is diversify our portfolio to maximize the potential to get some money back. And over, I think this was a stat from a year or two back, but angel investors typically invest about 25 billion plus into the economy every year. So it's not trivial, the amount of money that's invested. Any questions so far? Anything online?
I have a question.
Yeah,
So
sure.
diversify would be like putting your eggs in different baskets.
That's exactly what it is. So the question in the room for those who were on Zoom was, what is diversification? And it's a finance tool, right? Which is, you want to definitely make sure that you have money allocated in different types of investments so that you can minimize the risk of any one.
I think someone asked, what is an angel investor? Like, how do you become an angel investor? How do you get that title?
Yeah, so let's
Jump ahead.
yeah, well, I think the slide starts to talk a little bit about it, but I just kind of touched on it, right? That these are individuals who have opted to join this network, or sometimes on their own, just decide that they want to invest money in businesses that are very promising. But we could talk about the motivations for why someone would want to do that, right? And so I kind of alluded to this in the beginning. It's not all altruistic, right? Or heavenly angelly, right? It's really about getting money back. And so we'll talk about that as an extrinsic motivation. Personal motivation for a lot of people is, this is an opportunity to invest in companies that you really believe in. And there's all kind of different companies. I personally love companies that are focused on culture and organizational climate and DEI and inclusion. And so as an angel, it's an opportunity to invest in those kind of organizations. It also, for some of those folks who I talked about who may have had some successful exits, it's just a way for them to keep their foot in the business world, right? And we see a lot of deals, like a lot of companies. And so there is an intrinsic learning that comes with being an angel investor as well. So those are some of the intrinsic or the inside motivations for people, the stuff that kind of moves you personally. But then on the outside of it, people invest money to get money back. And so it's really important to recognize that when you go and seek out angel investing, there is going to be a lot of questions about, how am I going to get this money back, right? And it can either come back in the form of a note. So you'll hear this term convertible notes. And a convertible note is like a loan where we will say, you'll give us 6% interest and you'll have to pay back this loan at a certain point. Or it can be in equity. And so one of the important things to know is, if you are interested in becoming an angel in seeking angel investment, we typically like companies that are incorporated, because the incorporated companies will have stock, right? And so that's what that equity is. And so some angels will say, all right, well, in exchange for us giving you $500,000, we want 20% of your company. And it's not a bad thing, because that's how you start to get to valuations in your organization. And so once you start giving up equity, then people understand how much you're really worth. based on that equity that you've given. And then the other part of it is, let's say you're super early in your business and there's a lot of potential for you to ultimately sell your company. Part of the motivation could also be, hey, we want to get money or we want to get a discount preference early on from you so that when you go into your next pricing round, which is, could be seed, it could be Series A, Series B, Series C. But whenever you go into those next rounds where you're going to get more and more money, potentially from a venture capitalist, we want to be able to get some preference to have a discounted rate so that we're buying that share lower than what other people would be paying. So those are that extrinsic money kind of motivators for folks. I'm going to pause and see if there's any questions on that.
Hello.
Hi.
So I was wondering if the angel investing has control of the company as well, or he only invests in exchange for equity.
So what was the first part? I heard the equity part. What was the first part of the question though?
If the angel investing has company control too.
That's a really good question. So the answer is it depends. Sometimes there are these things that we call a lead investor. And when you have a lead investor, they're the main ones who are gonna, so not to get into all the boring details, but when you decide that you want to go raise money, you need to have something that's called like a cap table, which kind of keeps track of how much money you want to raise. And you typically will have a number in mind, $1 million, $2 million, whatever that number is. And oftentimes what you need is one company who's going to say, we're going to be the lead investor for you. And when they're the lead investor, that means they're going to go shop your deal around to other investment organizations as well. And sometimes in exchange for this lead investor putting a lot of money in, they may want to have a seat on your board of directors. And anytime you, as an incorporated company, anytime you give up a seat on your board of directors, you're giving up some level of control because those people who are on your board of directors can make decisions along with you. And so you need to be very, very careful about who you put on your board of directors, because all these companies out there who've had people on their board and those people have said, you're out, right? We need to bring in someone else. And that absolutely can happen. And depending on how much money an investor gives you, they may ask for a seat on the board. Great question.
Yeah, thank you.
You're welcome. Any other questions?
I have a question.
Yeah.
How does selling 20% of the company work? Like, what does that mean in as an impact to you? And
Yeah, so it's so the question for those on Zoom is, what does it mean to give up 25% of your company in equity? So that means, so when you have, like, most of you today are 100% owners of your business, right? As you start giving up more and more equity, these other people become like shareholders in your company. So if you sell your company, the equity that you give up means you're going to get less money when you sell, but it also means you could potentially be giving up less, you could be giving up control as well. And so one of the important things to remember as you start giving up equity is you never want to give more than 50%, because you always want to be able to retain that voting power, because those shares become, say, in the direction of the business. And so sometimes you can give up so much of it that you've diluted yourself out of making money, or you've diluted yourself out of making decisions. So that's why we care about keeping equity. Yeah. I'm a big proponent of, if you know that you have a successful idea, I'm a big proponent of do a convertible note versus give up your equity. Because imagine if you have $1 billion business and you've given up 50% of that equity, you're going to be leaving very upset. And I probably shouldn't have said that, because You're not going to get to $1 billion without giving up some equity, but just be careful about how much of it you give up, especially in the early days. You don't want to give someone 20% for, $10,000 or even $100,000. You want to make sure that if you're giving up that big of a chunk, it's going to be a lot of money coming back in. Good questions. Okay, so let's talk about other sources of funding too, because I talked about the fact that angel investing is just one source, but most of us in the beginning of our business journey are doing something that we call bootstrapping. And if you look at the numbers at the bottom, about close to $200 billion a year are raised or put into the market through bootstrapping, through us just funding our businesses ourselves with our credit cards or with money that we're making and reinvesting it back into the business. That's what we call bootstrapping. And it's not a bad way to go, especially if you're going to be making money and you just keep pushing that money back into your business. It actually protects you from diluting yourself. So I'm a big proponent of bootstrap as long as you can, because the minute you start going out and seeking funding from other people, they have expectations that they put on you to get that money back. The second way that you can get money in the super early stages is through friends and family, right? And so they may, you might go to friends and family and say, hey, do you have 1,000 here or 500 here to help me put back into the business? If you do that, the one thing that I would suggest to you is that you do put something in writing, right? Because you don't want someone, your cousin twice removed, to come back to you 10 years down the line when your business is very successful and say, I own a piece of your business because I gave you money. So if you are going to use friends and family, make sure you have legal documentation that shows the terms of what you're going to need to give them back and when you're going to give it back to them. Okay. And then crowdfunding. So there's a lot of crowdfunding sites that are out there that will give money to you. And I think you don't actually have to pay those back, right? It's just people who are kind of donating. I am a super cautious person. I just believe ideas are, especially good ideas, can readily be taken. And so I would be careful about going out to crowdfunding too early in your journey, because someone could snatch your idea and go make it happen in a different market. Then you'd be kind of pissed off. And then there's accelerators, right? And so accelerators, like Y Combinator is one. Oh my God, Kim would kill me. What's her father's called? Okay, I'm sorry, I'm blanking. There's another one here in San Diego with a woman named Kim King. Her father runs it, and I am blanking on the name. But anyway, accelerators, what they do for you is they will help you to get your idea off the ground. I think this is probably, the Rec Innovation Lab is probably an accelerator of some sort.
Institute?
The which one?
Founders Institute?
Not
Or-
that one. I can, anyway,
I know,
yeah. And then there's incubators too, right? And so the incubators sometimes will help you. They will give you space, they might give you money, and they usually want equity back as well. And so that's one to think about.
Except for the rec.
Except for rec.
No, we are a hard no when it comes to taking equity. We
Yeah.
will not take your equity. We
Yeah.
will not take your IP.
Yeah.
We are here to help you.
Yeah. Yeah, no, that's awesome. It's
And that's
a
very-
great benefit. It's
Yeah.
totally unique. Yeah, it's important. So there's not to steal thunder from the Rec Innovation Lab, but there's also a group called Techstars, right? Which is a pretty famous organization, and they're doing a partnership with SDSU coming up. So if you're a company that's really in the tech space and you're looking to accelerate your kind of speed to market, that could be a good program.
Were you asking about Kim's?
Yes.
Evo Nexus.
Evo Nexus, thank you.
Is that-
Thank you. Yes, Evo Nexus is the local one here, and Walt King, I think.
Yep, King, yep.
He is,
Kim King's-
he's great. Yeah, Kim King's dad is a great person to know there.
Yeah, I know.
So angels are kind of in between 3 and 4. So 4 is when you kind of get to that really big stage where you have something that's well proven. You're already probably making millions of dollars. You really want to amp it up and scale it up. That's when we go to venture capitalists, right? Those are early ideas that these companies want to fund. Usually platforms or medicine, biotech is what gets funded through these. All right, any questions on funding sources?
I had a question, just that is, so you think that angels are they the most effective investors within an organization?
So, so angel investors have a special place, and they're right between 3 and 4. In fact, I think I have a slide on this right here. Yeah. So you want to go to an angel right around the time where you've kind of proven your idea, right? So you have a proof of concept, you think it's really going to work, you're ready to move into like innovation, or prototyping and like market introduction. And I can tell you, for us, we typically look at, you already are in market, you have some traction. So when we talk about traction, we're talking about sales that you already have. People have, you've already proven that kind of product market fit, which, have you all heard of that terminology? Okay, so product market fit is in the early days when we have an idea, we're like, oh, I have a great idea and I think it's amazing. And when we talk about product market fit, this is about, does the market also think that this is an amazing idea enough that they're going to pay for it? And so when you have an idea that you know the market is going to pay for, that's probably the right time. And you now need money to like scale up. So you might need marketing dollars, you may need sales dollars, you may need engineering dollars, but you know that this is going to work and you need money to help amp it up before a competitor does. That's when you want to go to an angel investor. Does that answer your question? Sounded like it might have been a little bit different.
No, it helped. It definitely helped, and I understood it way better than I was previously.
Okay, good.
Thank you.
And then there was a question in the room about VC.
Yeah, it was in the chat. They were asking the difference. Is a VC the same as an angel investor?
So no, a VC is different, right? So a VC, if you look at the kind of top line here where I say pre-seed and seed and then series A and later. So venture capital, they're typically going to be funding you. Oh, I took it out. There was a slide I had in here that showed the kind of numbers. Venture capital is typically going to be providing like $1 million, $2 million plus, probably up to 10, 20 million in dollars. Angels are usually going to give you somewhere between 250 to 500K. And so venture capital are big dollars, right? Like super big, where you have partnerships, you may have institutions that have put money into this pot. So we're talking hundreds of millions that venture capitalist firms typically have, not millions like an angel investment group might have. And then later stages, so I want to talk about, there's a difference between VC and private equity too. And so private equity companies typically come in when a company has reached maturity and doesn't know how they're going to grow anymore. Private equity typically comes in and they help you figure out a better strategy, or they're buying you because they want to take apart your company and they feel like there's something very valuable in an asset that you have. So I don't always think about PE firms as being particularly friendly firms, right? They're kind of wolves out there waiting to get the money. Okay. All right, so let's go to then what you should think about. So let me just go back here. So let's talk about like when you're ready for angel investment. And so you're ready for angel investment when, again, you're having recurring revenue from your product. So you have pretty predictable numbers that are coming in. You probably have a solid base of customers. So you have identified who your target market is. those are the ones that are coming in. You may even be ready to stretch out beyond that primary target audience, and you have perfected your business model. So you know what you're selling, you know how much you're selling it for, you know your unit economics, how much it costs for you to make it, how much you're going to sell it for, and you know your value prop, right? Here's the value that we offer to the market. All of those things start to matter. And then I would layer in there your team, right? You have a team that is ready. And so most of the time when people come and talk to us and they pitch, we are asking questions about who else is on your team, what kind of experience do they have, and how do we know that they're going to be able to take this money and double, triple, quadruple it? Because again, we're looking for multiples on that return. Yeah.
I'm kind of wondering how you think about like on that traction side of things of you know, having recurring revenue. Like, how do you, like, different businesses are obviously like have different revenue models and different quantities and amounts of sale and stuff like that. Like, how do you think about looking at a business and analyzing, like, does this thing have traction or not?
Yeah.
I know you kind of gave like the little pieces, but
Yeah.
like,
So a big thing, what's your name?
Matt.
Matt, thank you, Matt. So a big part of what ends up happening when you go to an angel investing group is they're going to do due diligence on you. And in that due diligence process, they're going to get under the hood of your financials. And so they're going to say, hey, give me your balance sheet, give me your profit and loss statements, and I want to see it over the past couple of years. And what they will be looking for is, are you growing, right? Preferably, are you growing at double digits? Where are you spending money? And we do analyze at that level. Sorry, let me just figure out how to turn the volume down on this one.
It's all the way turned down.
Okay,
It's
all right.
loud.
Okay. So we're typically looking at, you know, what kind of growth, where are you spending your money? Because that's how we can know like what you're really investing in and how you're planning to grow versus what you're telling us. And then we look at how much revenue are you bringing in every month consistently. And we fund at New Fund, we fund a lot of SaaS companies.
Yeah.
And so with SaaS, it kind of makes it easy because you can see churn, how many of your customers are leaving, because that reduces your customer acquisition cost, how many are staying with you, and then what does that revenue consistently look like?
You guys, you're relying on kind of historical, so people need to be in market for whatever, some period of time to have something to show.
That's right. That's when I talk about the traction,
Yeah.
right?
Okay.
You got to have some significant customers. And most of the folks that come to us have somewhere between, you know, 400,000 to $1 million plus in revenue that they've been making already. So it's not trivial. Yeah.
So I was trying to think, I've heard someone say, well, if you're going to use angel investors or a VC, you need to be looking at this as an exit strategy. Like you're going to end up, you start at some point on that curve where the angel investors usually when it's low, and then you want to sell when it's high. But I'm thinking about people like Mark Zuckerberg, who had Facebook, and he obviously didn't sell the company, but he was able to get angel investors because he was incorporated. He had a corporation, and he was able to sell shares. So is that why New Fund wants you to be incorporated so that there's shares and they don't have to make you sell your company to get their equity back in?
Yes. And I don't know if you heard on the phone what the question was, but the question was, why do angel investors look for companies that are incorporated? And yes, so that's one of the reasons. So one of the reasons is because once you become an incorporated company, preferably in Delaware, you have shares of stock, and that means we can get equity in your company. But the other reason why we like incorporated companies is because if you're in an LLC, it's entangled with your personal finances, and you also might have partners. And so we don't want the mess of figuring out who really owns the company. When it's a corporation, it's the corporation that owns it. So it just makes it a little cleaner to distribute that money as well. Looks like, are there any other questions on chat too that?
There was one that was asking about how do you get the value? Where is that number derived?
The value of, for valuation.
Valuation.
Yeah, so it's really hard. In the beginning of your company's life, you won't know what the valuation is because you're just kind of starting up. Over time, once you start getting those first investments and you do get equity, you kind of divide like that equity. Someone can give you like what's the net present value based on the assets that you have. So you can kind of get an idea of what your company might be worth based on that net present value. And then you would divide that by the equity that you've given up, and that starts to give you what your company is worth. And every time someone invests money and you give out more equity, that valuation continues to go up and up. In the beginning, though, when you're early in your company and you don't have a valuation, which a lot of companies don't, there will be something called a safe, right? And a safe is just a way of saying, we don't really have a valuation in your company yet. We want to give you money. And so it's just another vehicle that we use to help kind of put some kind of value on your company.
I have a question. Why did you say Delaware?
So Delaware, so yes, good question. Carla had a question about why is Delaware the place? So most companies incorporate in Delaware. And so the tax laws, the corporate laws are all kind of based on that structure. And so it makes it easier to kind of understand how to do business there. And so most companies will incorporate in Delaware. And most lawyers that you would go to help you incorporate, they will know how to do it. Less tax too, by the way. So I incorporated in Delaware, and instead of paying, a flat tax to California, like when I was in LLC, I was paying $800 a year. Instead of paying that, I pay something like $400 to Delaware. And I made money in my company last year, and my taxes are very low in Delaware. So I think it's just more favorable for companies in Delaware.
So you don't need to live in Delaware.
You don't have to live in Delaware. Nope. Your company just gets incorporated there. Yeah. Good questions. Okay. All right. These are great questions. Keep them coming. So I talked about like how angel investors evaluate companies, and they're going to grill you. I mean, they're going to rip you apart because they want to make sure they're going to maximize the chances of getting money back. But you should also be evaluating angel investors that you go out and seek. And all of the angel investing groups will have different theses, right? So a thesis is just, here's what we believe in investing in. And so it's really important for you, if you're going to go seek funding, to understand what kind of companies does this angel investing group fund. So you want to understand their track record, right? How many exits have you actually had, right? Someone talked about an exit. So an exit is just you selling your company, right? And so we love exits because that means you're going to sell your company for a whole lot more and we're going to get our money back. But it also means, if we've had a lot of exits, it also means maybe we're able to provide some good mentoring and support that help you get to that exit as well. So that's one thing you should be evaluating, like what do they care about? How committed are they? And what's the track record? You should also be looking at the deal terms. You don't want to pay 12 or 15% interest, right? You want to pay probably something closer to 5 or 6% interest on that money. And so if the terms start to feel like they're out of whack, that may not be the right angel investing group. It may be a loan shark. So you have to be careful there. And then you need to think about, like, what am I going to get from these folks? Like, how smart are they? Have they dealt with businesses like mine? And are they willing to help me? So one of the companies that we funded, I sit as a board observer for them. And it's not a formal seat, so I don't have control like what we talked about before, but it is a way to just lend and contribute knowledge. And then, yes, so we talked about the other two. What do you care about investing in? And then how many exits have you had? And you care about the exits because that'll tell you how good they are at evaluating a company and also being able to help you maybe network with people who might be in the market to buy your business as well. Okay. And then, so let's talk about what happens. When you, let's say you find you're ready, you're making money, you're ready to scale up your business and you want to go seek angel investment dollars. And so a couple things happen, and we call this the deal flow process. And so the first thing that happens is we're gonna get referrals, and we're gonna say, hey, here's a company. Matt has a company. He's growing like gangbusters. I think it fits with what we're looking for. We want to bring him in. So we do introductions to the angel investment group. And this is why, by the way, being in groups like this really matter, because a lot of where we source companies that come from programs like this, right? And we've actually had some Rec Innovation Lab folks pitch to our angel investing group as well. It was really good exposure, and you kind of get a feel of what's going to be asked of you. So, but some of the referrals will come as well. And then what we do is we then have a couple of folks look at your company and say, does this fit with what we care about? And if so, then we'll invite you to come in and do a formal pitch to the group. Usually the pitches are about 15 to 20 minutes, where you're pitching for about 10. And then we have about 5 to 10 minutes where we're asking you questions. And we can talk about some of those questions. If you successfully get through the pitch, then you go into the due diligence process. And that's the question you had, Matt. This is where we're going to say, all right, we need a deal room where we want all your financials. We want to understand a little bit more about who works in your company. We want to talk to those folks. We want to talk to you. We want to understand everything that's been happening. What's your strategy? So it's really letting this angel investment group come in and get under the hood with you. If you get through the due diligence process, and that process takes usually a month or so, it's a lot of work. It's a lot of work for us too, because we got to find people to kind of come in and work the due diligence, to do the research and homework. And it's usually people who have some level of expertise in your business area. And if you get through that round of due diligence, and we say, okay, we want to fund you, then we just have to kind of get on your cap table and go through all the legal ramifications of it. And then you get money. That easy. The reality, it's not that easy, right? And so the reality is, we're going to be looking for, how have you been good stewards of the money you've already had? What do you want to use that money for? And so this is really, if you come in and you tell us, you're a SaaS business and you have a low cost of acquiring customers, but you're asking for $1 million to do marketing, we're gonna be like, why? Right? Like, what are you using that money for? So you got to make sure that everything that you're saying kind of holds together. And so I've been in ones where we've had 3 or 4 different meetings with the founder. We have asked to speak to their chief financial officer. We've asked to speak to their marketing folks. We've asked to speak to their engineering folks. And at the end of the day, we've said no. Right. So there is no guarantee that once you get to that due diligence phase that you're going to get funding. All right. Any questions on that? I'm going to get a sip of water. Okay. So let's go to the pitch.
I'm just gonna ask really quick before you jump into pitching. Is there anything you can suggest about how the relationship dynamics and organizational values, like, is there any word of caution or any suggestions you could make as far as making sure that this organization you're essentially partnering with has your same corporate values?
Yeah, and that's when we go to this back to this evaluating the angels, right? Like, and I'm sure some of you glossed over when I said what's their investment thesis, but that's really important. What do they care about? So New Fund really cares about SaaS and about biotech. So if you're a company that's not in SaaS and you're not in biotech, you might have to evaluate, is that the right angel investment group for me to go to? Because they probably won't be interested in me. The other thing that I look for now is diversity of the board, of the, not just the board, of that group. Because that's going to tell you a whole lot about how open-minded they are too, and what their perspective is. So those are a couple things that I would look for. So let's talk about pitching. Who loves pitching in here? Yeah, one person. I love it. I love it. I don't like it. And so, oh, you love, oh my gosh. So you got the whole trifecta. You love sales and pitching, or double, whatever a double is. Then this is the slide for you then, right? Because the pitch is so important when you come in. And the mistake I tend to see people making is they get so in the weeds on their product that they forget that your product is really just one part of the story. What we really care about is, what's your competitive advantage, right? How are you going to be beating someone else? So your sales background comes in handy here, right? Here's how we're going to win. And here's what we offer that nobody else brings. And here is what, here's how we're going to capture all those pocketbooks through what we offer. So that competitive advantage becomes really, really important. And that can be in your technology, it can be in your product, but you want to make sure that that comes to life. The other part of it is the innovation itself, right? So is this something, oh no, is this something that the market needs, right? So sometimes we have ideas and our ideas are brilliant, but the market isn't ready. And if the market isn't ready, they're not going to buy it. And so that's what I talk about when I talk about market readiness. Does the market know that they have this need that you're trying to bring to the market, or is it going to take a whole lot of education to get them there, and maybe they won't? And so we will probe questions around that, right? Who has this problem? How do you know? How big is it? So all your TAM, SAM, and SOM really does matter. And then patents and intellectual property, trade secrets become really important, because that's the way that that competitive advantage that you have starts to come to life. And so the legal stuff is really, really critical. And then how are you going to spend that money, and how are you going to use that money is the other part of it. And those are all the things that we're listening for in your pitch. So I didn't mention a whole lot about product in there. Like, clearly, if you have a good product, all these other pieces are going to be there. And that's what we want to hear about. How are you going to make money? Because that's what we want, is to get the money back. Any questions on the pitch? Yeah, Tanya.
So, do you recommend that it's good to keep a pitch, like a recorded pitch, in case people want to, share, or and then also like, how many pitches should you sort of have on hand ready to go? 30-second pitch.
Yes, you need to have the 30-second and the 2-minute if you're going to be doing the San Diego Angel Conference for sure, right? Because it's like they take you through those stages. I think it makes sense. You never know when you're going to need just an elevator pitch. Like, you might run into someone who doesn't have 10 minutes to have you walk through it. Valeria came to one of my classes and I put her on the spot and said, can you show the class how you do your pitch? And she did a 30-second pitch like that. Just spit it right out. And so, what I'm glad you asked that question, though, because a lot of people think about the pitch as that point where you're going to get money.
Yeah.
And it's not.
Not at all.
It's not. It's the point at which you're going to generate interest for people to say, we want to hear more. And so think about, if you ran into someone in an elevator or a hall, what can you say to them that's going to get them to want to know more and to remember your name? So that's why I think having multiple versions is important. I love the idea of having video pitches ready, just because as you apply to different funders and funding sources, they may ask. So you just have it. I hate recording. Everyone who's maybe not Matt maybe doesn't like to do these over and over. So having a good one on hand is probably a very good strategy. All right, so let's talk about other things. So we talked about the legal and the competitive advantage and how you're going to use the money. But the other parts of it are around who's on your team and how strong are you as a leader? How much experience do you have doing what you're doing? And most importantly, do you listen? Like, there's so many CEOs who don't listen. And if you're not coachable, I don't want to give you my money. Because if I see you doing something that is going to lose my money and you don't want to hear it, then it's sort of like, what's the point? So all those things are really, really important. The team. So early on, when I started my journey with New Fund, we would have founders who would come in and they would bring team members, and like the CEO would overtalk everyone. And we'd be like, ooh, that's not good, right? They're not really using their team. That's not a team, that's a dictator. And so we do look at what's the chemistry among that team. And one of the things that sucks that I've been learning recently is most of these angels want to see co-founders. And it makes me cringe because I personally don't want a co-founder, but I think what it does is there's always two heads are better than one. And so there's always the weakness that you're going to have as a CEO. And so having that balancing act is really, really important. And then obviously just the potential of what you can be. And so do you know who you are? Do you have a brand story? Do you have a marketing story? And does it matter to your customers? So all of these things get evaluated in that 10-minute pitch, believe it or not, and we can see it very readily. All right, so then my last slide is just on, after you go through your pitches, you go through the due diligence, you've gotten funded, and post-funding, you want to make sure that you use that relationship. And so use the angels for mentoring. You may ask people for board membership. So the bigger you get, you do want to have a board. And so these become a really important place to get some of your board memberships and directors for your company as well. So that's all I got. We'll open it up for our last couple of minutes and see if there's questions. And random questions are welcome too. I really have gotten insider scoop. Yes, Angela.
The board membership
Yeah.
is because it's incorporated, you have a board of directors. So
Yeah.
this would essentially mean a seat on the board. Have you heard of anyone doing committees, like subcommittees within the organization and having angel investors sit on those committees
I
to
have
bring in any like experience or knowledge or?
I have not heard of committees, but I can tell you a lot of orgs will say, they will reach out and say, do you know anyone who's in this field? Can you give me recommendations or help connect me with people? And we do that. Most of the individuals who do angel investing are pretty busy, right? And so you want to maximize any time that you get, you want to use it, you want to use their network. I can't imagine, I don't think I would sit on a committee.
Yeah. That makes sense.
Yeah.
Okay, and see here. You have dictatorship, is that? for-
Directorship.
Or directorship, sorry.
Yeah.
So, really small, my screen. What would you mean by that? Is
Yeah.
that the CEO's role, or is that the chair of the board of directors, or is it both?
Yeah, so there is, so when you have a company and when you incorporate, you actually do at some point need directors of your company. And those directors have a whole lot of power. So like, secretary, president, vice president, and they have a lot of power. And so you want to be careful about who you bring in for that. That's what I mean about directorships.
Yeah, I think a lot of people, from what I've heard from startup founders or student founders, is they're scared to give up equity, which they should.
Yep.
Initially.
Yep.
But, and I've heard horror stories actually of where, you have partnerships. So you end up splitting your equity with someone. And then your partner, this one particular person had that partner say, I want a third partner. So then they split it into threes, and then the two partners gained up against the other partner.
Yep.
And it was kind of like, a loss of power.
That's
and
right.
Here this one person put in all the work, and so.
Yep.
That equity is definitely, something not to mess around with, and to definitely have lawyers involved in that process or a contract. to do it.
Totally. Yeah, don't just you know, some people, I think it's a great story. Don't just think about your shares as something you can do like monopoly money with, right? It is power. And so are those directorships. And so when I incorporated, I was going to put like, you know, family member, friend into these director positions. And my lawyer said, don't do that, because they then get equal power to you in the company and they can throw you out. And so you're right about those stories. And that's where the co-founders become tricky, because, you know, if you have invested the ideas and someone else comes in and they don't like it and they have equal power as you, what do you end up doing? At the same time, you know, understanding and recognizing when you need a co-founder is really important too, because again, we don't all have strengths in everything.
And there's also opportunities to hire people instead of giving up the equity, you hire an employee who has that strength, right?
Totally.
If you're at the sales position or.
Yeah.
Yeah.
And that would be a good use of a loan, right? Even from an angel investor, you could say, I want a convertible note and I'm going to go hire a sales leader and I'm going to go hire a marketing leader, so that you don't have to give up that equity too. It's a good question. Yes.
Can I ask do you have one? Sure. Can I ask like a slightly technical
Yeah.
question? I'm gonna try not to ask a leading question.
Okay.
Has your job changed, like as an angel investor, has your job changed with the changing economic environment? And if so, how?
We don't know yet. So, I mean, like at Silicon Valley Bank, First Republic, all of that is fairly new. Last year, I can tell you, we had a really big fund year. I think it was like close to 7 million that we got. We do anticipate that there will be some pullback this year because the economic conditions have tightened. So that's from a, you know, are we putting money in? From a funding who we're funding perspective, I have seen the conversations get very tight, right? So there's companies that come in that do like discretionary HR stuff. And even though they're a SaaS platform, we're not funding, because in economic slowdowns, we know that companies aren't going to fund that discretionary spend, which means your business is going to slow down. So we do take a look at the economic conditions and try to think about what businesses are resilient against that. And it does take a little bit more work to think about, like, you know, what can stand the test of recession and what can't. Does that answer your question?
Thanks.
You're welcome. Did you have a question too?
No.
Okay. All right. Any other questions on the Zoom? I was going to say the phone. Zoom.
Yeah. Looks like go. Yeah. You did a
Awesome.
great job.
Yay. Well, this was fun. I'm
Thank you.
happy to be here. I think I have my email address here. Yeah. So if you have any questions, feel free to email me. I am happy to field questions. And feel free to link in with me as well. Cool. Well, nice to see some of you on Zoom, and have a good evening.
Thank you, everyone.
Yeah.
This is awesome.
Yeah,
Really
I guess I
appreciate it. Great work done. Thank you.